Good afternoon, and thank you for that very kind introduction. A German politician recently said that all of Europe is speaking German now, but unfortunately that's not true of me, so I apologize for speaking in English. I also need to apologize for upturning the program. But I have a family emergency which requires me to return to London early. For 6 decades, Europe has been gradually coming together. But recently, it has been disintegrating at an alarming rate. Economically weak and politically divided, the European Union faces a series of crises that threaten to overwhelm it. The Eurozone's economy remains weighed down by huge debts, zombie banks, and high unemployment, as well as poor productivity growth and dismal demography. Greece's membership of the Eurozone remains in doubt, as indeed does the long-term survival of the Eurozone. EU leaders are at each other's throats over economic policy, refugees, and much else. Politics is increasingly fractious and fragmented, with both the far left and the far right capitalizing from economic misery, a loss of faith in mainstream politicians, and in the case of the far right, fears about immigration and security too. Poland has joined Hungary in having an authoritarian government that challenges the rule of law and liberal democracy. Border controls are being reimposed within the supposedly border-free Schengen area as the EU struggles to cope with the arrival of more than 1 million unwanted refugees and migrants last year. Europe is also threatened by Islamist terrorism and an aggressive Russia. And against this inauspicious backdrop, Britain has just announced that it will be holding a referendum on whether to leave the EU on the 23rd of June. And a British exit, a Brexit, could also lead to Scotland leaving the UK, which in turn could embolden Catalonia to try to seek independence from Spain, and indeed cause the EU to unravel even further. So the theme of this year's Karlsruhe Dialogues could scarcely be more topical. Now that's the big picture. I only have 15 to 20 minutes, and other speakers are covering many of these other topics. So I'm going to focus more narrowly on the political economy of the Eurozone, what's gone wrong, and how to put it right. The Eurozone is in a terrible mess, both economically and politically. While this is partly due to its defective design, it is mostly due to catastrophic policy decisions since the crisis that began in 2007, compounded by flawed changes to the Eurozone's governance. Resolving the ongoing crisis requires a shift in policies, and institutional reforms are also needed to make the Eurozone work better longer term. Now let's start with the facts. Whereas the US economy is now 11% bigger than it was before the crisis in 2008, the Eurozone economy is still slightly smaller. In fact, 8 years into the crisis, the Eurozone is doing worse than Europe was at this stage of the Great Depression of the 1930s. In fact, it's doing worse even than the countries that remained on the gold standard until 1936. And while the situation in Greece is truly catastrophic, This is not just a southern European problem. Finland's economy is 7% smaller, more than 7% smaller than 8 years ago, which is worse than Portugal. The Dutch economy is doing worse than France. And as for Germany, while its economy has grown by a bit over 5% in the past 8 years, that's less than Britain, and it's less than half as much as Sweden and Switzerland. So while there is a wide variation across the eurozone, this is systematic, collective underperformance. And likewise, while unemployment is scarily high in southern Europe, especially among young people, overall unemployment in the eurozone is still over 10%, which is twice as high as in Britain and the United States. Now, part of this underperformance is due to structural factors, not least demographic decline. And it's also due to national policy failures, not least the failure to introduce reforms to boost productivity. But most of it is due to bad decisions at a eurozone level, some of which have been partially corrected, like the premature lurch towards excessive collective austerity in 2011 and 12, but others of which have not. The biggest policy mistake is the pro-creditor bias of the crisis response. And this began with a decision to bail out failed banks, starting with the German government's bailout of IKB. And then with a decision in 2010 to bail out the creditors of an insolvent Greek government, primarily French and German banks, rather than to restructure Greece's debts. These bank bailouts have shredded political trust in politicians and EU officials. The failure to clean up banks' balance sheets has sapped economic growth ever since. And the bailout of Greece's creditors transformed a crisis caused by the bad lending of private banks, a crisis that could have united Europe in a collective effort to curb the banks that got us into this mess, into a conflict between governments, indeed a conflict between nations, which has stoked up nationalism and is tearing Europe apart. After all, German and other European taxpayers would now take losses if Greece obtained the debt relief that its economy needs to recover. Worse, the bailout of Greece's creditors and the subsequent EU loans to Ireland, Portugal, and Spain created a devil's bargain where the quid pro quo for German financial help, ostensibly to help taxpayers in those countries, but actually primarily to bail out French and German banks, was a loss of control over national decision-making. So in effect, Greece has become a glorified colony of the Troika. The Greek people's right to manage their affairs stripped of them for the foreseeable future. More broadly, the fiscal compact and the tightening of EU fiscal rules have stripped national governments of autonomy over tax and spending decisions in a way that is economically dangerous and politically poisonous. Economically dangerous because countries that share a central bank and an external exchange rate need greater fiscal flexibility, not less, especially at a time when demand is depressed and monetary policy is increasingly ineffective. And politically poisonous because every time voters reject a government, as they have done at nearly every occasion during this crisis, the first thing that happens, even before the new government is in place, is that EU officials, and indeed Wolfgang Schäuble, appears on television saying, you must stick to the failed policies of the government that you have just rejected. Now think about this. No taxation without representation is the stuff of revolutions. It was the rallying cry of the American War for Independence. The European modern equivalent could be no welfare cuts without representation. Is it any wonder that the EU is now so unpopular? And is it any wonder if voting for mainstream parties does not deliver meaningful change, that people increasingly vote for the extremes of left and right? This situation is politically unsustainable. A eurozone that fails to deliver better economic outcomes for its citizens and curbs their basic democratic choices over taxation and spending cannot be held together forever by fear of the consequences of breakup and the rapidly eroding remains of the European political capital built up over the past 6 decades. The belief in Berlin and Brussels that the political center will hold forever and that others will capitulate, as Greece ultimately did, is deeply complacent. What if we get Beppe Grillo in government in Italy or Marine Le Pen as president of France? So what then is the way forward? To resolve the crisis, Eurozone governments need to do what I advised President Barroso when I first met him in 2010. First, we need to clean up the banks, and we need to restructure the unbearable household and corporate debts which are holding the economy back, along with Greek government debt. Second, we need to combine increased investment, both public and private, with reforms to boost productivity and thereby pay higher wages. It makes no sense to make a fetish of fiscal rules which absurdly treat borrowing to pay higher salaries to bureaucrats equivalently to borrowing at near zero interest rates to invest in projects that boost present and future economic growth and thereby tax revenues. And it is madness to bear down on wages in a beggar-thy-neighbor pursuit of export competitiveness, a deflation-exporting form of competitive devaluation which ends up beggaring ourselves. And third, we need to enforce the EU's new macroeconomic imbalance procedure on both the Netherlands and Germany, whose huge and growing current account surplus is the largest, most destabilizing and dangerous imbalance in the eurozone. And this would not be painful for ordinary Germans. It would be good. It would mean higher wages. It would mean more investment. It would mean stop squandering your savings by being badly invested by German banks overseas. And if we look to the future, the Eurozone can only thrive if it reforms its economic governance. Now, we know from experience in the United States, Germany, and elsewhere, that federal systems work reasonably well in diverse monetary unions. So one option, longer term, would be a federal union. But that is scarcely feasible, desirable, or even necessary anytime soon. Because at a time when support for European integration is at new lows, and ill feeling between countries at new highs, it would be a catastrophic mistake to try to impose common fiscal institutions and some of the trappings of a state on the Eurozone. If this were feasible at all, this would not be the social democratic idea of a Keynesian eurozone treasury accountable to a eurozone parliament. It would be Wolfgang Schäuble's vision of a supranational fiscal enforcer, in effect the current system on steroids. So short of breaking up the eurozone, what is the alternative? It is to restore the no bailout rule in the Maastricht Treaty, and this time make it credible by creating a mechanism for restructuring sovereign debt. This mechanism would not operate automatically when countries encounter liquidity problems, but only if there is a very high probability of insolvency as determined by a reasonably independent and competent institution. And to make that mechanism credible, banks' holdings of sovereign debt would need to be capped. And if governments that have borrowed too much have their debts restructured rather than being bailed out, the fiscal rules could be loosened or even scrapped, and democratic say over fundamental decisions about tax and spending restored. Now, this ought to be acceptable to German ordoliberals because it respects the principle that liability and control should be aligned. National liability, national control. And it would also weaken the incestuous links between banks and governments, something which the Eurozone's new banking union was meant to achieve, but fails to do. And if you take Wolfgang Schäuble at his word, if you limit banks' holdings of government debt, then suddenly Europe-wide deposit insurance becomes possible. Now, there's a big debate going on at the moment about whether the new bank bail-in rules that have been created in the Eurozone are a good idea. I think it is a good idea in principle that when banks fail, their creditors should be bailed in rather than they be bailed out by taxpayers. My fear, though, is that the new rules are going to be applied asymmetrically. They'll be applied to banks in weak countries, but not to powerful banks in France and Germany. And it's pretty clear that the rules that we have created for winding down failed banks are unworkably complex, and they leave a veto in the hands of national governments. So what we need instead is a European version of the FDIC, an independent body that provides deposit insurance and the willingness to resolve failed banks. And last but not least, we need to challenge the biggest taboo in the Eurozone, which is the excessive independence of the ECB. Now, in other countries, independent central banks have operational independence. They try to hit a policy target which is set by democratically elected politicians. And there is no question that in a crisis, the central bank is ultimately a part of the government. So it is inconceivable that the US Federal Reserve would fail to step in to quell a panic in the US Treasury bond market. But the ECB has no political master. It floats above governments. Its independence to set, and in recent years systematically miss, its inflation target is unchallengeable. It's able to sit on its hands for years while panic ripped through and almost destroyed the Eurozone. And it's able to step well beyond its mandate for monetary and financial policy to demand fiscal cuts and indeed structural reforms, which may or may not be desirable, but certainly are not part of its job. All of that, and the ECB is scarcely accountable to the European Parliament. It deigns only to a dialogue with parliamentarians. It fails to provide them with sufficient information to adequately scrutinize what it is doing. And they lack the powers to hold to it account, to discipline or even disbar officials who either fail to comply with their mandate or indeed overstep it. And this urgently needs to change. So let me sum up. The eurozone has taken a wrong turn during this crisis. It has lurched towards becoming a technocratic, anti-democratic creditors' racket, instead of working in the economic and democratic interests of all its citizens. The solution is a change of policies to finally put the crisis behind us, and institutional reforms that restore democracy, that enable better countercyclical economic policies to combat recessions, and which separate the fates of banks and governments and thereby enable us to curb the political power of banks. This won't solve all of Europe's problems, of course, but it would be a big step forward. Thank you.